Good evening, and welcome. Welcome, everybody, to the stream. Tonight, there is a lot for us to unpack. As we all are familiar with, there is a lot going on in the UK macroeconomic picture right now. There's an economic crisis that potentially may have been averted with the Bank of England stepping in, but there is a lot of uncertainty still persisting. As you can see here, the GBP to USD chart is basically one-way traffic. The pound has been at multi-decade lows. Of course, we've seen the bond yields soaring and then plummeting on the back of the Bank of England intervention. And there's a lot of thoughts about what this mini budget that sent the UK economy into basically a tailspin means for the UK economy, but also what are the implications, the potential flow-on effects for global economies as well. We've got an insight into central bank decision-making, as they've obviously chosen to step in. As you know, there's many central banks around the world that are currently in the process of choosing to try to unwind their balance sheets and reduce those. But of course, Bank of England here has transitioned towards plans for QT and into QE, obviously there to preserve and maintain efficient market functioning. Today, we're going to spend our time thinking about it. We're actually going to talk about what's been happening in the UK macroeconomic picture, but then more importantly, what are those key factors that we need to consider for the global economic picture? And what are those risks? The risks of contagion, obviously the European winter is about to head through. As about time as mentioned here, Europe heading to a very cold winter. And we saw what happened with Nord Stream over the past couple of days as well, which is going to have implications for gas prices, energy prices. We saw some of those energy producers flying on the stock market as well. And so there's a lot of discussions on that front. Harry dropping in saying g'day. If you're tuning into the stream, pop in, say hello, let us know how your day's been so far. If you've been watching the UK economic crisis, let us know about that. Or just let us know what you've been watching on the markets. There was a very good day, one of the best days in the past couple of years on US markets last night, flowed through to the Asian session, obviously the ASX as well. But we'll see how we're going to be heading into the new session tonight. Not long to go, basically 3 hours to go until the next session. As we know, we're into the back end of September. Obviously, that brings with it the end of a quarter as well as the month. So maybe we'll see if the last quarter of the year as we head into a potential Santa rally will be better, or maybe it won't be. And of course, there's a lot of uncertainty on that front too. Richard, welcome home, mate. Thanks for the updates. It is an absolute pleasure. It's good to be back. There's going to be plenty of live streams on this channel. So if you haven't yet, make sure you've subscribed with your bell notifications on. As you can see now, we're going to be dropping live streams whenever there's interesting things to talk about. So if you are interested in catching up with the streams, be part of the community, say hello. We talk about all things on the market, from lithium and the electric vehicle rollout to technology. Obviously discuss a macroeconomic picture, as you can see tonight. But we like to keep it interesting and mix it up across the board. Let's have a look at where things are currently sitting right now before we talk about this discussion. As you can see here, we've got a few different slides to work through tonight. We'll talk about some of those major factors here. But first and foremost, what I do want to have a look at is where the US markets are sitting. They were about a percentage off when we started this stream. So as you can see here, this is the 1 minute for the S&P 500. We can see it's come in over the past couple of hours now. And we're about 1% off on that mark. US tech, so the growth end of the market, off a bit worse, about negative 1.3% there. And the Dow is around about 80 basis points off for the session. Obviously, we had about a 1.5% session gain yesterday, depending on which indices you're looking at. But this is where we're currently sitting. When are you traveling again? Mid-October. So we'll be off again in mid-October. Got another, now it's 2 or 3 weeks. And then, heading back over to London, which will be exciting, which I guess is very relevant to today's discussion point too. Alrighty, so let's have a look at tonight's kind of topic. As you guys know, I'm not a financial advisor. Nothing we discuss on the channel is financial advice. It's all just a general discussion. Hopefully, it's an interesting starting spot for you to do your own research from. If you're just tuning in, if you're just arriving in, hit that like button, drop in, say good day, let us know what you've made of everything on the markets. But let's talk about what is actually happening. So, when we take that step back, as we know, the current setting itself, Liz Truss has just taken power. Obviously, Boris Johnson resigned. So we've got a new regime or a new leadership on that front. But we also know Europe in particular is undergoing an energy crisis, but obviously that's flowed through to the rest of the world. As we saw what happened with Nord Stream over this past period, it's yet to be resolved. Energy prices continue to soar. And obviously the UK has not been immune to that. And, you read these stories and these anecdotes about people not being able to have their heater on and they're currently freezing. And obviously, as about time mentioned, it's going to get pretty cold. It looks like it's going to be a cold winter up ahead. And so there is an energy crisis. There's inflationary pressures flowing through. And those inflationary pressures hurting, obviously, disproportionately. As we know, inflation is a regressive tax, which means it's going to disproportionately affect those on the lowest income scale. And so there is cost of living pressures flowing through. It's not just energy. You got your food bills, you got your housing, you've got everything that's rising. Inflation, as you can see here, highest levels in 40 years, 10% inflation. So this is not small matter. We know it's happening in the US. We know it's happening in Asia, in Australia. We know it's happening in Europe, but the UK, it's happening there as well, and quite significantly. But with that backdrop, what is happening is that the Bank of England and the other central banks around the world are doing whatever it takes to try and quell inflation. At least they've committed to getting that inflation back to that 2 to 3% band, really that 2% band sustainably over time. Now, it's not going to be immediate. It's not going to be quick, but we've seen successive rate rises from many of these central banks, and they're putting their foot on the brake, trying to slow down the economy and curtail inflation. So obviously, that's where we're currently positioned. We all understand that backdrop. It's happening in all of the nations around the world, but the UK, because of its location in Europe and obviously the proximity to Ukraine and everything that's playing out there, it has had that effect kind of amplified. And so when we're sitting there with that, as we can see here, the mini budget came through. So this mini budget, it's classed as a fiscal event. It's obviously not a full-blown budget, but heck, the implications and ramifications from this budget getting rolled out, it may as well have been a full budget. It was significant. So they rolled out the mini budget. The new chancellor rolled out his first mini budget here, along with the new Liz Truss regime. Now, what was coming through? It was focused on energy and tax cuts. Kind of the highlight or the top level thing to consider here is that there was $45 billion of tax cuts, which obviously will be funded by borrowing to make up that deficit. So the significant tax cuts, the top level of the top tax bracket was abolished or removed, which means that obviously it's going to benefit the highest earners as well as corporations. And as you can see here, the basic rate was cut, but scrapped the 45% top rate for high earners. The banker's bonus as well has now been scrapped. So the cap limiting payouts has been scrapped, and the corporation tax, there was going to be an uplift in terms of the corporation tax. That's been scrapped as well. Now, why are they trying to do this? Obviously, the central banks are trying to kind of quell demand, but the focus from the Bank of England, not the Bank of England, the fiscal side, so the UK government was aiming at stimulating the growth over the medium term in the economy, trying to avoid a recession, which is obviously counterintuitive and goes against what the central banks are trying to do. And this sent a lot of shockwaves and thoughts and uncertainty into the economy. Now, if you're just joining in here, I can see a few people jumping in and saying, "G'day, Richard Lama, AGL closing cold 10 years early." I did see that. I saw that. ASX Rider, hey, how you going? Hope you're going well as well. Yeah, it's great to have you join us. I always love having the community popping back up. Justin Gates as well. Never underestimate the power of the Fed and the governments. This is an interesting one, and we will talk about this later on in the video about about what are the implications for other central banks around the world. So what Justin Gates is essentially referring to here is many people are anticipating that at some stage we're going to see pivots, because obviously they've been significant and almost unlimited levels of support out of 2008, and really trying to make sure that we've got those functioning macroeconomic systems. And so, yes, they want to put the brakes on. They want to slow down the economy, but they don't want things to break. And that's what the Bank of England basically stepped in and backstopped with the pension funds, which we'll talk about in a little bit. But that's what Justin's referring to here, if you're wondering. Hearing more and more about China's economy collapsing. Yeah, there's a lot going on that front too. We'll talk about that throughout. Trying to understand, will the tax cuts contribute to inflation? So this is an interesting question from IT Transformation. And look, this is essentially kind of the big question here now, right? Because central banks are trying to quell inflation. But if you think about tax cuts, what are they ultimately going to do? If you're paying less tax, that is going to mean there's more disposable income for people. So let's just say you had $1,000 or £1,000 a week in terms of your income. If you were previously paying, let's say 45%, then that means 45 out of, £450 out of every week was going into the tax. Now, if you're only paying 40%, £400, you've got £50 left each week. So obviously, now it depends what you're going to be spending your disposable income on, but at an aggregate level, when that happens enough times, then obviously the notion is that people are going to be spending more, and that's going to be stimulatory for the environment and can contribute to inflation, which is why there was a lot of questions and uncertainty about kind of the decisions here and kind of how it contrasted against the central bank's aims, which is to reduce inflation. But if you're putting more money into people's pockets, then obviously that has the ability to be stimulatory. And that was the government's opinion here, which was they wanted to try and stimulate the economy. Glad to see you well and adjusting the new location. Thank you, mate. It's a pleasure. So we're back in Oz for the next 2 or 3 weeks, but we will be kind of heading back in mid-October. So plenty more to come. As you guys know, if you're just tuning in, make sure you've subscribed and turn your bell notifications on for plenty more videos on the channel. Jim as well, very uncertain times. There is. Better sit on the fence for a while. I think a few people are kind of taking that type of approach. Hope you're going well, mate. So where are we up to now? And also, let us know what you think about this new style of live stream. That's the idea. We're going to be doing these types of live streams where we just find what's interesting, what's going on in the markets. We'll walk through it together as a community. People can share their thoughts, share their ideas. I'll share some of mine. We'll chat about it. We'll reflect on them. And I'll keep dropping live streams in whenever there's anything interesting to talk about. And over the past period, there's been a lot of interesting things to talk about. So they could be consistent. So that's why you need your bell notifications on. Now, what was the effect? The effect of these tax cuts and this mini budget, the bond market had its worst day since the early 1990s. So yields were absolutely soaring. You can see the 10-year yield rising there on the top level. The sterling, so the British pound, found its lowest level in over 30 years against the USD. And heck, we're nearly reaching parity against the US dollar, which was just about unheard of. Over the weekend, the Chancellor then promised potentially larger tax cuts as well, which led to a deeper bond sell-off on the Monday session and the pound sinking to record lows. So essentially, there was huge uncertainty and almost mayhem and chaos in the markets, as evidenced in the bond market, as well as the British pound and the currency. And now there are a few important implications here that we need to think about. So first and foremost, if you're thinking about the British pound weakening against the US dollar, as we know, commodities and a lot of trade, but commodities in particular, are often denominated in the US dollar, which means that if you're losing your purchasing power against the US dollar, and in the same rate, not only is the British pound going down and getting sold off, but the US dollar has been soaring as well. So you've got that kind of two-way effect. But when you're thinking about that happening, obviously that is fairly significant for things that you're trying to import. So that is affecting commodities. But Britain, UK is also a net importer of energy. Now, what is already soaring at the moment? Energy prices. And so if the pound is losing its purchasing power against the US dollar, if the pound is losing its purchasing power, and energy prices are going higher, this is only going to exacerbate the cost of living crisis, because it means that it's only going to get more expensive for energy if these things hold. And so that is something that is fairly significant. Obviously, a range of different implications for other imports too. But the energy one is first and foremost one that people are thinking about. And now on the other side, when we go back here and we think about the fact that there was $45 billion of tax cuts, right? Now, where are the tax cuts going to be funded from? The tax cuts were going to be funded by borrowing. How do governments borrow? This is through their government bonds. The UK government bonds are called gilts. If you're wondering why you keep seeing the word gilts, that's essentially the name for UK government bonds. In the US, they're called T-bills or treasury bills, but that's just what gilts are, if you were wondering. And so as a result of that, when you've got yields rising, the cost to borrow for the UK government is going to rise. And so we've seen this significant run up here, right? You see this absolutely massive run up here. And then what's occurred is, you see, so Kwasi Kwarteng, the Chancellor, delivers his mini budget September the 23rd. Yields start running up. Yields then hit their highest level since 2002, just a few days later after the weekend. And then the Bank of England intervenes. But what you're seeing here is the cost to borrow for the UK government is going higher. So they've got a higher debt burden and it's becoming more expensive to import things because of the reduction in terms of the cost reduction in terms of the sterling. So all of this is playing out right now. Richard's got a question here. So please explain why governments are stimulating the economy while the central. This is a question that many people are having. And it is why this tax cuts and why these decisions and this mini budget has attracted a lot of contrasting views. And in fact, there has been some seriously kind of disappointment from the analysts and economists about kind of the decision here, because you're essentially putting on the brakes with the central bank, and then you've got the government slamming the accelerator on. Now, what's going to happen to the engine? That's obviously going to hurt it overall. And that's exactly what you've highlighted there. So, yeah, it's almost like they're trying to avert or avoid a recession that might not be avoidable. Sometimes, as they say, the recession that you might need to have to have. And so it's a good question, and there's no answer for that one there, Richard, unfortunately. In terms of what happened here, as we can see, so the UK government bonds plunged. The Chancellor said markets will react as they will. So essentially, the government's saying we are going to make the decisions here and not allow ourselves to bend to the decision or the mechanisms and movement of the markets. But then 5 days later, the Bank of England stepped in to prevent the chaotic drops in bond prices from stinging the pension funds and threatening financial stability. And we'll talk about kind of how that happened and why that played out. But a route that began with the package of energy subsidies, with the tax cuts, had threatened to snowball out of control with a £1.7 trillion slice of the UK pension sector. So we're not talking a small amount. And when you're talking about pensions, this is people's savings, right? This is the long-term future of your country. And so this is why the pension sector is really, 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 really important. And so this slice of the pension sector dominates the market for long-term government debt. And it struggled to cope with the unprecedented rise in bond yields because essentially the strategies that many of these pension schemes used to shield retirees from inflation and interest rate risk, so there was hedging strategies, were buckling under the rapid move. And we can see this move here, okay? So this is where we are. Richard, AUD weakness continues, Labor budget coming up. Will they stimulate again? It's going to be fascinating to see. Fascinating to see on that front. So this is where we get to. So on Wednesday, the Bank of England stated they will be stepping in because of the turmoil at pension funds, because there was essentially a self-fulfilling downward spiral in terms of these bond prices. So the Bank of England was going to be selling off its bond holdings. So that's called unwinding its balance sheet. That's quantitative tightening. And as we know, around the world, most central banks are trying to unwind these balance sheets, which have been expanded rapidly over the past few years. Well, yeah, out of 2008, essentially, when we're talking about what Justin was mentioning here. Yep, they've announced they'll be doing bond purchases at a pace of up to £5 billion a day for 13 days to restore order. So they are time limited at this stage. But you've got to understand what was happening in the system. So essentially there was soaring yields, which we see here. So yields went soaring after the mini budget. So yields going higher. When yields are going higher, that means bonds are selling off because bonds have the bond prices have an inverse relationship to yields. So if yields are going higher, bonds are selling off. If yields are going down, then that means bonds are being bought. So that's why you got to understand that. It's a little bit kind of counterintuitive if you're new to the bond market. But soaring yields meant that pension funds needed funds as soon as possible to satisfy margin calls. Because obviously if yields are going higher, then bonds are selling off rapidly. So they were getting margin calls. And as we mentioned, these pension funds are a key pillar in the economic system. So if they're suddenly getting margin called, what do you have to do when you're getting a margin call? You need to have cash to front up to pay off your margin call. Now, what happens if you don't have cash on hand? And obviously, if these are big margin calls, you're not going to have cash on hand. You need to sell your assets, right? You've got to sell your liquid assets. So what was happening is they were getting margin called on one hand, the pension funds, and suddenly they need to sell off their liquid assets quickly. So they're selling things such as kind of short-dated bonds or things like that, whatever it was, they're selling the liquid assets. And as they're selling these liquid assets, then obviously it becomes a self-fulfilling prophecy downwards. So as a result of that, the Bank of England was like, hey, hang on here. We don't want a disorderly sell-off and kind of the market functioning breaking. So we need to step in. And so the Bank of England stepped in. They said they'll be purchasing bonds for a 13-day period up to £5 billion a day. But the key factor here is the focus of the central banks, the Bank of England, was not aimed at being stimulatory. The central bank's intention here was aimed at protecting the market functioning. Now, that's different from some of the past quantitative easing that we've seen, which was aimed at being stimulatory because obviously we needed to restart the systems. Well, that was at the start, depending on your interpretation of why it carried on. But this was not aimed at being stimulatory. It was just aimed at making sure the system didn't collapse under the weight of everything that was playing out. So there was a distinct difference there. But nonetheless, it was quantitative easing, and they unleashed a bond purchasing program. Areem, how you going? Welcome. If you're just tuning in, drop in, say good day. If you haven't yet, make sure you've subscribed, turn your bell notifications on as well. We do plenty of live streams. We're back with the streams now, so we'll be plenty of these. We'll be dropping them in at random times whenever there's anything interesting to kind of unpack. You'll be able to tune in for them. So turn your bell notifications on. Say good day as well. Drop in if you're just like Areem and tuning in now. If you've been watching since the start, say hello too. It is always great to have you join us. Great summary. Saw the headlines during the day and now understand a lot better. James Green, hey, by the way, under the channel ID. I love it, mate. How you going? Great to have you join us. Good to also get the context of who you are, because I was like, oh, that's a new username there. But great to have you join us, James. Yeah, there's a lot going on. If you guys are just tuning in, pop in and say good day. All right. So what are the key questions here? I'm sure you're like, okay, there's a lot of questions here. What actually happens now? The Bank of England intervention. What does this mean for the inflation fighting? Because we've got the central banks trying to fight inflation, trying to raise interest rates to quell inflation. And then, as Richard says here, buying bonds adds to inflation. And ultimately, the flow and effect of that is if you can't get inflation down in the short term, well, then potentially higher interest rates. So that is probably the first question that a lot of people are wondering. It's worth noting that we might not get many of these answers in the short term. Monetary policy operates with a lag. And obviously, fiscal policy also operates with a lag because it doesn't happen immediately. But these questions are important to understand so that we know where things are going to be heading kind of in the short to medium term. Just trying to see which view is better. Oh, interesting. We've got a different view here as well. So we can go on that side, this one, that's on the side. Here we go. Just trying out the new views. I haven't done this one before. So maybe we can move them over. So the second question that we have is, will the purchases be time limited and cycled off quickly? So obviously, as we saw back here, £5 billion a day for 13 days to restore order. We've got a time cap on it. But what's worth noting is that what is initially intended as temporary can become permanent or longer term. Not to say that this will or won't happen here, but if things need to be supported, they need to be supported, right? And suddenly you can fall into a system where things are being supported for too long, i.e. What Justin mentioned here, where you've got a huge amount of support coming in from central banks. Essentially, the tap wasn't turned off for 12 years after the GFC. And when the tap's not turned off, then you don't reset things. So that's kind of a key consideration, right? And then on the other side, what will be the effects of the tax cuts? So we obviously discussed the tax cuts before. There are implications on the tax side in terms of being stimulatory, but what's it going to mean? But then the second consideration here that we've got under that factor is, will the cost of living pressures, will they persist? Because yes, the tax cuts came through, but if we're cycling back to here, right, what are we seeing? We're seeing the top highest earning tax level coming down. We're seeing the basic rate cut by £1 to £19 from April 2023. You're seeing corporations having their tax cuts falling down, but essentially it's trickle down economics. You're trying to stimulate the economy from the top end, and then if the top end is stimulated, you're hoping that will flow through flow through to the lowest income earners. But who's most under pressure from the cost of living pressures? The people who are just struggling to pay for the gas bills, to keep the lights on, the heating on, and to be able to pay for their food, as inflation's at 10.1%. So cost of living pressures will still persist there. Other implications, will other central banks follow suit if necessary? Obviously, this is the first kind of decision or discussion that we've seen from the UK. But look, things potentially could continue to break. And it seems like at the moment, if you look at the markets and macroeconomic picture, it seems like we're not too far away from things potentially breaking. Who knows? Maybe they won't. But there's a lot of fear at the moment. As you know, if you're on the contrarian indicator side, perhaps peak fear means maybe this is the worst of it. But if things continue to break and if there's risk of contagion, I know ASX Rider mentioned up above, here, other economies as well, such as China, like what's happening there. So what will happen on those fronts? And what will the central banks do there to support their economies? Now, will we see pivots coming through if market functioning is threatened? The big one will be for the Federal Reserve, because that's where a lot of eyes are kind of honed in on at the moment. When will the Fed pivot come? Because if the Fed pivot comes through, a lot of people are anticipating that could be a sign of a bottom, or at least the worst of it being behind us. Now, who knows if we will see that Fed pivot come through. Obviously, we know the Fed put is essentially dead at these high levels because you can't really have the Fed put coming through in times of inflationary pressures. But it's an important question, right? It's an important question there. And then really another one is, what happens if you push down the accelerator and the brake at the same time? You don't need to be an engineer to know that that's probably going to be not positive for a car if you're pushing that in the engine, but also the economy. And so obviously, if the central bank is trying to slow things down and the government's trying to speed things up, well, what's going to happen? It's almost like the unmovable force versus the unstoppable object. So yeah, that's an interesting one. And then finally, the contagion risk, right? Because obviously, this is only limited to the UK at this stage. But if things break there, well, it has the ability to flow through to other economies around the world. The UK, yes, it's been moving like an emerging market in terms of the macroeconomic picture over the past couple of days. But as we know, the UK is a significant leading global economy. And so it does have the ability, and it interacts with many other economies around the world to impact those. The recession needed for reset in the UK and US, Richard thinks only solution. Time lag will take years to flow through. And let us know your thoughts on it all as well, guys. Drop in a comment. Let us know if you like this new style of live stream where we chat through things and you guys are able to share your thoughts and we go through them together. This is the Dow Jones, negative 0.7%, slightly better than where we started the stream. Not quite at the peak yet, but slightly better. As we can see here, we've got the US tech, so NASDAQ just over 1% down, about 1.1% or 1.2% closer to. And then US 500, S&P 500, about a percentage off yesterday's close. So it's an interesting time. As we can see, ASX today, it wasn't the worst day on the markets after a solid day yesterday. So about 1.4% added after yesterday's good session on the US markets. But we'll see what flows through if there is a weaker session on the US side. Spot gold, as we talked about, below that 1700 mark. Will be fascinating to see if the inflationary environment persists. Basically, every currency pair against the US dollar is weaker because the USD is acting and operating like a safe haven. It's one of the only things that is operating like a safe haven at this stage. It's a fascinating time. We've got some upcoming videos on the other channel, on the ASX Investor channel. We just dropped a video with Brickworks, one of the leading ASX 200 companies. They're one of the largest dividend paying blue chips kind of there, or with the most consistent dividend. So you can check that CEO interview out after this stream. We've got some other live streams coming up over the next few weeks. So make sure you subscribe, turn your bell notifications on this channel. There's plenty of other videos for you to check out. A big thank you for joining us. It is a fascinating time. I've got to go eat some dinner because I am starving. But it's good to be back with the live streams. Subscribe, bell notifications on, hit the like button. Plenty more to come. Interesting lithium video coming out this Sunday that I think you guys will enjoy. Go check some of the other CEO interviews out on the ASX Investor channel. A big thank you all for now. Have a fantastic night. We'll keep you updated with everything that's going to play out. Check out another video. Stay well and happy investing.